Well, Jerome Powell leaves rates alone, but there's a lot to go over here, especially what happened with semiconductors. But you can see the move today, and we can watch what happened right here and see exactly when they made what they made, which was nothing. As always, they did nothing. But what happened from that 2:30 on? You started rallying. Why did we rally? We rallied for a couple different reasons, and we're going to go through it in a second. But I think it's very important to just note at the end of the day, you can see that 4 o'clock level. Every single thing that we made, we lost back at the end of the day. And why? This had more to do with just a sell the news event, specifically about what was going on overseas with Iran and the threat towards Israel. And now we have more political risk, obviously because of what happened today. And it does seem like things are getting a little I guess the best word to say is it's escalating. Let's leave it at that. So what we're seeing here is we're just seeing panic. There was a statement that was made and that created this level of panic. But if you look here, this is where we did nothing. What I like to do with these periods of time is exactly what we do with any piece of economic data. You always mark off that level. Just like as people know that have been watching these videos for some time, you always mark off that 830 piece of data, whether it's CPI or PPI. You do the same thing when that news first hits of them not doing anything. And that shows you exactly where the algorithms and high frequency traders are. And you can see how we came right to that level right there at 330. And then miraculously we found the spot and then we bounced up to that 4. And then you just see the selling down. And then of course the rally into the close. Now, if we take a look at NQ, this is where it gets somewhat interesting. We're going to have to talk about why. But if you look at NQ, you have those same levels. Now, is NQ stronger than ES? And I would say yes. Now, why would I say that? Because you couldn't even get to that level. And then look at how you just rallied. You hardly came back down on the news. You didn't come back down to there. And then you rallied into the close. But that last 10 minutes, what happened? And it's important to watch those last 10 minutes. Why? Because you're seeing those market on close orders. We're seeing up front what they're doing. We're going to spend a second talk about RTY. And I think this is important because a lot of people don't really get the concept that this is super thin. I think your market capitalization is what, 4% of the S&P? Something insane like that. I don't know the exact statistic in front of me. But again, look what happens when we mark off that 2 o'clock level. Test, rallies all the way back up, retest, and then hits. So maybe you might want to consider marking off these levels when you're trading during the day and you have a Fed meeting, and you'll see that. Now, his speech today overall was extremely dovish, meaning it wasn't just one rate cut. He was talking about that is the trajectory, that is the way that we're going. And that is very clear. I'm going to show you a couple things that will highlight this very objectively. Now, before we begin that, we are seeing a change in trend. And I do want to go through this change in trend. You can see 24 is marked here. This is ADP non-farm payrolls. Now, non-farm payrolls will be released, but ADP always comes out first. ADP only uses ADP data. BLS is the big one. I'm showing you this for a reason. You have a change in trend. If you look from 24 over, you can see very clearly how we were going up. And then from March over, we could just see how they're dropping. Now, what does this show us? This shows us employment of companies that have 30 or less employees. So ADP does payroll. Their average client is 30 employees. That's all they use. They don't use any data that doesn't use ADP. So this always shows you what small businesses are doing. Small businesses are not hiring. They are actually dropping off the amount of people that are doing their billing, and their payrolls are dropping. This is really important to watch because this is a precursor to what's going to happen with non-farm payrolls. But it also tells us what's going on in this small business community, which is where a lot of people in the US are employed. Now, I'm going to show you a little trick that I do, and you can always do this yourself. Now, we've all known that this Fed Watch tool, I've shown this a couple times. And what's nice about this is it shows you exactly the probabilities of each Fed hike or Fed cut and what they're going to do and what those chances are. For example, in September, at this particular period in time, down here, it's July 31st, and you can see right there, it says 12:40 is the time. CT, Central Time. Now, why is this important? We're going to get to this in a second, but this is important because it tells us the target rate probability for the September meeting, and you're going to see 525, 550. You can see objectively how this meeting, when he speaks, how it was received. And what you do is you just do a snapshot. And I mean, I do a physical snapshot just so I can compare it. So you can see right now at this particular time, there was an 89.6% chance of one cut. You could see that there was a 10.2 of 2 cuts, and you could just do the subtraction to figure out how you're getting there, and there's 0.2 on 3. And you could see this lined up right here, but we had a 60% move in the probability of 2 rate cuts by September. And I'll show you. So what you do is then you go and say, after he's done, and this is when he started doing Q&A and taking questions right in here. You can see the time. And what you'll see there, this is 2 hours later. What we're doing is we're just taking a snapshot, hour and a half later. What we're doing is we're taking a snapshot of when it's done and what he's saying. And then what we're doing is just very simply overlaying that and then looking at these dates. And you will remember, you can go back and rewind, but this was significantly lower. Well, we went from 10 to 6. You have a 60% chance increase just from today's statement that they're going to do 50 basis points. 83.7, actually lower because of this. And then, of course, you have 3. So you would actually look at this and go, well, wait a minute. You're at 16%. Yesterday, you were at 13. In the middle of the day, you were at 10. These are big changes, and that's predicated upon what he said. And I do think that he should have even considered cutting today. Now, it's just easier for me to show it this way. This gentleman is like a big bond guy. Everyone always makes fun of him. And this is just, everybody should know this account that's on Twitter. He just puts out really just the news. It's just straight news. That's all it is. But what's interesting about it is I agree with him. This Fed is always behind. You know, they were out there cutting rates and buying bonds, and they drove us into the highest inflation we had in something like 50 years. They just kept doing it, kept buying bonds, kept inflating the prices, and everyone loved it when things were going up. But now that a burrito is like $47, everyone's like, this is ridiculous. Now what they're doing is they're waiting too long. We now have had that negative CPI rate. But I do agree with this, and I just want to point it out. I don't think that we're seeing very strong margins here at all on gross margins across the board. You could look at Ford. We can go through some of these names and go through it. I think they're going to be late to cut. And I think that if you look at what investment banks are saying, so I want to show you something where they're saying we have 150 basis points of cuts, certainly in a year from now. I read a ton of information, and people that watch these videos know that because I'll present some of it, and I read a ton of research, investment banking research from a lot of these firms. It's just the way that I was trained. And I'll tell you something, that I don't have a firm that doesn't say 5 cuts in the next 6 meetings. That's the least. The majority are saying 6 cuts by them. And this is a big turn, and a lot of it has to do with the gross margins and the pricing power. And I think this is important. I do think that they should have considered cutting today. I do think that that's something out there. And he says the Fed has a lot of room for Fed to cut short-term interest rates. They do have a lot of room. And I'm going to show you why he's saying that, what he means by that, and what the problem is. Now, this is a great account to follow if you care about the bond market. He was trained by Bill Gross, who's pretty much the bond king. And I really like the comment because I agree with it. Consistent with past experience, the markets are interpreting Fed chair remarks as press conference as more dovish. Dovish means leaning more towards cutting than the FOMC statement. So the statement comes out, the statement reads decent. But the statement talked about their dual mandate and that they had risk to both sides. It's the first time you've seen them say that. I'll just say this. They are certainly leaning towards not one cut, but now they are leaning towards multiple cuts. And now they're just saying, when is this going to happen? We saw this in January where we were leaning this way before. But with the way the data is coming out right now, start watching non-farm payrolls, start watching this data, because it does seem to me like it's going to get more cuts. It does look like we're leaning that way, and we'll talk about which way that's going to lean us. Now, just to hammer this home with the rate decision, I think it's important to get this. This is just from Barron's, and I think it highlights the issues. Fed's confident can maneuver around lagged impact of increases. So the lagged impact of increases is a real nice way of saying that they are just behind the ball. And I agree with this. I think they're way behind here. Fed embarked on its plan to raise rates more than a year ago, but the impact of restrictive policy hasn't trickled into the broader economy full in the past 6 months. I think it's here, and I think it's wreaking havoc. Unemployment rates started to tick up, and consumer spending in particular categories, interest rate sensitive, have slowed. I mean, if you take a look at Ford, gross margins down, Mercedes down, Maserati down, Alfa Romeo down. These names are getting killed. Louis Vuitton down, Hermes down. Go and look at any of these companies on just the margin side. Chipotle was talking about it. Margins are down. It's just across the board. I think the only one that we saw that actually had decent gross margins was SFM. They actually were up. Powell acknowledged these concerns, and time is drawing near to make a decision. And they're always late. The central bank needs more data before pulling the trigger. It's very difficult, challenging judgment. We don't want to go too soon, and we don't want to go too late. The policy rate, 5.3, we still have a lot of room to respond, and we'll talk about this with the policy rate of 5.3. We don't see any reason to think this economy is either overheated or sharply weakening. Okay, it's just not in the data right now. Okay, we just had a CPI that came in at a 4-year low. CPI month over month was actually negative, and you haven't seen that since the pandemic. I think they have a problem, and I think they're trying to figure out how they're going to maneuver it. But if you look at this, just let me show you this, and then we'll go forward. So thank you for your comments. This is why this is now yellow, so I believe everybody can see the yellow more than the blue. But this is Fed funds. And now, so when they say policy rate, for those that don't know, what do they mean policy rate? Fed funds. Well, what is that? Right? Think of Fed funds as this is the money that banks borrow from the government. And then they take that money and then they lend that money to the street, what they're supposed to do. And what they tend to do is they want to lower Fed funds because what that does is then they can lend money to you. So in other words, if Fed funds is 5.3 and you want a new car, well, they're going to have to make money, meaning the bank's going to have to make money, whether it's Regions Bank or whoever you bank with, JP Morgan, doesn't matter. And they're going to want some basis points. And then if it's a regional bank, they're going to have more risk, so they're going to want 8%. JP Morgan might want 7% because they have a stronger balance sheet. But that's what makes monetary policy restrictive, right? It's just a real simple way of thinking about it. So when this drops, all of a sudden your car loan is what? Well, now you're getting a car for 3% or 2% or 1% or no money down, or your mortgage is like 2%. And what people got accustomed to was thinking that this was normal, and it's not normal. This happened from the great financial crisis, and this is where we are. But the question is, before I go off on one of my tangents, is what do they mean that he's got a lot of room to go? And I'll show you what they mean by that. Now, here is the 2-year Treasury, and you can see that right here. And what I'll do is just show you where it is right here. So you can do it yourself, US02Y, and you can see that right here. Okay. Then next, what we would do is just overlay US10Y. And I just want to show you where they are. You see where we're at, right? These levels? Okay. So then what we're going to do is we're just going to zoom out on these for a second. And what we're going to do is I just want to go back to this 23 area for a second. And then you're going to see this because I can only do this on a monthly and then we're going to break it out. But I want you to see this. So there you are in 23. And we can clearly see where the 2-year is and where the 10-year is. Now, remember that this is 5.3. When a bank gets money, they buy treasuries. Now imagine that you're going to go out there and you're going to borrow money at 5.3 and you're going to buy treasuries at 4.2. Well, that's not going to work. You're not going to make money. The only way that you're going to make money is you have to lever. That's the only way that you're going to make money off of that. Meaning I borrow $1 million at 5.3. I have to go out there and buy 2-to-1 and then margin that money up in order to get that yield. It's the only way to do it. And that's what regional banks, all banks do that. And then if you go ahead and we'll just do TXN because it's faster. And then even if you wanted long paper off of 5.3, you're still at 4.1. So when people like Gunlock or Iran or whoever it is, even if gross, it doesn't matter who says it. When they say they have a lot of room to move, this is what they're referring to. Okay? You could come down 120 basis points and you're still at the 10-year. On the Fed policy, right? You could still drop 100 basis points and you're still at the 2-year. So that's when they say there's a lot of room. All right, so if we think that way, we know that there's a lot of room. Well, what does that mean for us if there's a lot of room for interest rates to come down? What does it mean for us if there's a lot of room for policy to move? And the people in the community already know this, and now I'm going to bore you with it as well if you haven't heard this before, but I've gone over it a couple times. This is why home builders are hitting all-time highs. This is why you're seeing regional banks come out and break out, and they're breaking out of these multi-year bases. This is why you're seeing sectors like the Russell break out. Now, there's some other reasons for this too, but you have this multi-year breakout here on the Russell. Why? Well, they are more tied to interest rates. Smaller companies are more tied to interest rates than larger companies. Think of turning a ship, and if it's a smaller ship, you can spin it a lot faster. If it's a larger ship, it takes longer. Hence, domestic companies benefit more from interest rate sensitivity moves. It's just the way that it is. But if you think about that, well, why would XBI move the way that it's moving? Well, XBI is going to move the way that it's moving because these companies don't make money. They have to borrow money. Well, if you have to borrow money and money is cheaper to borrow, that means that the cost of running your business is cheaper. And your burn rate, which is what a company has, if they make no money, their burn rate is less. Therefore, biotechs go up. So they're the sectors that benefit from this, and there's a lot of room there. Really important concept to get because this is the concept and the theme that is going to be going on for some time. You're going to see TLT continue to move up. You're going to see the HYG continue to move up. IEF, well, we already know that, but like LQD will continue to move up. They just will. It's just a fact. And you can actually, Maybe I'll do it on Saturday, but you can actually go through calculation to determine how much these are going to move predicated upon the amount that they cut. It's actually really that simple. You can just actually figure it out by the duration and then the amount of the move. But this is what's going on. So interest rate sensitive names or high yield stocks are going to be in demand. And you're going to see that, and that will continue. I think it's a really important concept. You might want to watch that part again. Now, the headline that no one is really paying attention to, and I think this is a great thing. I'm just going to leave it at that. All right, here's ASML and here's Tokyo Electron. Why are these important? They're going to be exempt from the U.S. rules. Now, let's be honest about this, so we're all on the same page. ASML is not a U.S. company. Tokyo is not electronics, is not a U.S. company. Japan and the Netherlands, this is what is on the tape or what people are talking about at trading desks. They said basically, we're not doing this. The Netherlands said we're not doing this sanction thing, and Japan said the same thing. I understand why they did that, and I understand why this is being phrased that way. I don't know really where the U.S. gets off trying to tell another country that they can't deal with another country. It's kind of interesting that they tried to do this, and I think you can see why it backfired if you go look at how much ASML is actually part of the Netherlands or how much these companies do in revenue. It's staggering. What's really good about this for semiconductors, no matter what your stance on it and your beliefs on whether or not they should do this or shouldn't do this, you're never going to stop technology. It's not going to happen. You just need to outperform and be better. You're never going to stop it. So, go look at the amount of NVIDIA chips that have been purchased in Singapore since this all started. Where do you think they're going? Anyway, if you take a look at this, what's important is this. This was something that was really how this was going to play out. Well, now we do know how this is going to play out. And this is really important. And this is why semiconductors were so strong. Now we have other things going on tonight that may weigh on them. And we're about to cover some of those now. The goal of these videos is to get you prepped for the next day. And then the end of week videos. So just as always, comment. And if you find value in these, please share them. It means a lot to me. I purposely don't run ads because I just try to prep people for the morning. And there's nothing more annoying than the middle of this for you guys to see ads or some kind of sponsor or something. So if we take a look at the stocks right here, I just want to point out the obvious. Captain Obvious. This is the 12. This is the 55. I don't even have the 22 in, but I think I'm going to get brighter colors for these so they pop for you guys. Some of you guys watch this on your mobile phone, which I don't know how your kids do it these days with your internets. But again, here you are. You can see the 12-22 cross. I use the 12 and 22 at 55. You should use what you're comfortable with. Does this look like something you have to run into? No. Does it look like you got washed out, you gapped up, and then maybe you could build here and base for a while and then push? Yeah, absolutely you could. But you have to look at this area for what it is. I think this is great news for ASML, and candidly, I have a position in ASML, and I'm very happy with my position. And we could see that base here, and now I think you're going to start seeing more order flow. But this is a chart that has a lot of construction that it has to go through, and we saw the route up, and we'll go through this right now, where NVIDIA is now, after hours, is up and over that 55 for the first time. But 1, 2, 3, 4, 5, you actually closed 5 under it, which is not ideal, and you're there. These are declining. You still have weight. You still have that weight on your chest here if these are declining, and you have to think about it like that. So yeah, I'm thrilled to death. This is something that we bought in the community yesterday at 105. It's funny, I always get told I just day trade. I trade what I see. If it's time to day trade, I'll day trade more. If it's time to swing, I'll do more. But here's the alert, just so you can say it. And that was 105. And I showed exactly, if you go watch yesterday's video, I'll link it at the end. You can see exactly how we found this idea, so you can go learn how to find them for yourself. Because most people would look at that chart and not understand how the heck do you try to pick that off. And it was pretty easy when you started overlaying the US dollar versus the yen. But anyway, all right, so now you're popped up and you're over. Does that mean you're out of the woods? No, I think you have a lot of damage in here that you have to get through, right? All these people up here that got gapped down on, they're going to be doing cartwheels. They get to get out. So I would think that this still has some pressure on it, but after hours, what we're seeing is these stocks started to rally, and now they're starting to sell off. Take a look at Qualcomm after hours, and I think this is worth our time, so we're going to spend some time on it here, and I'll go to a bear chart and get rid of the lines. And what you always do with these guys, remember after hours, you just drop an anchored VWAP there, right? You're always on that first bar. That way you can see the move. And what we're seeing here is you're seeing that rally, and then once you crack there, that's it, right? It's on like Donkey Kong, and then it just fell apart. Now, on the call, it didn't go too well, but also, remember, they do mobile. So I went here and you took a look at Apple. Apple's not affected by this, but Apple could be affected by this tomorrow. You're going to want to watch Apple because it also is not going great for ARM. ARM came out and they lowered guidance. Revenues are up, but lowered guidance. You just can't do that when you're trading at a bazillion times earnings. So, and bazillion's an actual number. And what you saw here is you got right to our level. And then from there, you just reject it. I did short this after hours. At the time of recording this, I am not short this. It would be quite possible, just a disclaimer, for me to be shorted again on any rally, because this, you just can't do this. I mean, you cannot be this ultra high flying name and then go, by the way, we're lowering guidance. I mean, you can't earn 30 cents and be trading at 150 and say, we're going to lose money next quarter. Like, it's just, it doesn't work that way. So it's all in expectations, but you guys already know it's all in. So be aware of that. That's what's happening after hours. So there's a couple others that we should go over that I think are really important. Meta, I am shocked. I was short this and I actually did well with it after hours. I'm shocked that this is up. They're not going to give guidance and they raise CapEx. So they said, we're not going to give a lot of guidance. And I haven't listened to the call yet because I had to record this, but I'm kind of surprised that it's up. And I don't know how this is going to act tomorrow. Maybe because it's so beaten down, but for me, I don't know. I don't think this was a great quarter. I know they beat and everyone's looking at like the headline risk. Oh, look, we're up and we beat. But why are you not giving guidance for the year? And why are you increasing CapEx? So once again, there's no increase in the dividend or anything like that. Now, maybe they're doing something on the call. It's going exceptionally well, and that's why it's up. I don't have an answer to that. I mean, I'll have to listen to it later, but I think this is pertinent. And then if we just go here for a second, look at these other earnings plays. They're not lighting the world on fire tonight, guys. So Western Digital's down 4%. CVNA is up 12%. That quarter's suspect at best. But overall, it just really wasn't great. So what would I do tomorrow? I would watch the semiconductors. I would see how they act. Do they continue to rally? Do you see money behind it? How much effect does ARM and Qualcomm have on Apple going into its quarter? Because now this is a real issue. Are we going to have a problem here because of what we saw? We'll cover it tomorrow morning. If you don't, pre-market, we always do pre-market 8 o'clock at a.m. and that's live and it's public. You can always attend or you just watch them later. I leave everything recorded. That's it.